welcome everyone to our webinar. Our topic is Empower Your Financial Future, Mastering Self-Directed IRA and Solo 401k with Checkbook Control. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with Checkbook Control. Our speaker today is Brett Synicky. Brett is a solo 401k and self-directed IRA consultant here at Sense Financial with a professional journey spanning over 18 years in real estate investing. Brett is also a licensed California real estate agent, and his passion lies in empowering people to attain financial independence, affording them the possibility of an early retirement. So thank you, Brett, for joining us today, and I'll let you take the floor from here.
Okay, thank you, Natalie. Can you hear me okay?
Yeah, sounds good.
Excellent. All right. Yes, I appreciate the introduction. Thank you very much. And just to note, Sense Financial is not a fiduciary. We don't provide legal, tax, or investment advice, accounting, or other professional advice. If you do need something in that realm, you should consult your tax professional or tax attorney or somebody like that. Let's see. Okay. Our mission is to help. And by the way, let me back up real quick. So we are talking about the solo 401k versus the self-directed IRA. We're going to talk about both. These are the two products that we offer here at Sense Financial. There are some differences between how we do it and what we offer versus competitors. So we'll talk through that a little bit. But primarily, we're going to talk about the inner workings of the plans, the qualifications required to participate in each one, and also just the nuanced differences between the two. And so our mission is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. And you work hard for your income and your money, and we want to come alongside you and work hard alongside you as well. And we approach that from a stewardship perspective. Your future is very important to you, and we want to treat it as such as well. And so what we have with investing, you have two sides of the equation. Okay, you have the conventional side. Think about the bus that's on the track that picks you up and drops you off at certain spots, and also, doesn't go off the track, right? In this case, it's kind of like a bus slash subway above the ground. I don't know what you call that. I guess that's called a train, right? But you have this train or bus or whatever. It doesn't really go off the track. It has to stay on the surface streets of the city that it's in. That's the stocks, bonds, and mutual funds that most people invest their retirement accounts in. And then on the other side, contrary, opposite the bus or the train, you have the off-road vehicle. And this vehicle is capable of driving on the roads. It's capable of driving on the highways, the freeways, but it's also capable of taking a right turn or a left turn off the street and going on to a dirt road, or even a road that isn't really a road, and doing some off-roading and even driving through water or whatever. And so that's the self-directed side of the equation. We are providing the vehicle that allows you to do that, to self-direct your retirement into what we call alternative assets. And alternative assets can be, some examples, trust deeds, Bitcoin, cryptocurrency of any type, tax deeds. You can become a private lender. You can invest in gold and other precious metals, commercial real estate, residential real estate. Really, the IRS doesn't tell you what you can't invest in. They only tell you, they don't tell you what you can invest in. They only tell you what you cannot invest in. And it's collectibles. Think about stamps and baseball cards, maybe some coins, and then life insurance policies. And those are the only two things that they say you cannot invest in. So really, the sky is the limit when it comes to this. So we offer two products, as I mentioned. We have the self-directed IRA on the left there with a ton of people, because virtually anybody can qualify for a self-directed IRA. And we'll talk more about that, but that product is available for just about anybody. And then on the other side, you have the solo 401k, and that is primarily designed for small business owners and their spouse. And so there is a self-employment qualification for the solo 401k, whereas the self-directed IRA does not have that. And we'll talk more about both of those. First of all, let's cover the self-directed IRA. So what is it? What is a self-directed IRA? Well, it's a tax-deferred trust account. You do have to have a custodian with all IRAs. Okay, so it's held with an IRS-approved custodian, and self-directed, as we've been talking about, allows you to invest in non-traditional assets. And it's actually been around for a long time, since 1974. So why is it so little known? I think it's more well known, day by day that goes by, more people know about it because of companies like ours promoting it and such. But still, even though it's been around for 50 years, it's still not super well known. And I think part of that is because people who get advice from financial planners may not be told about it. Either the financial planner doesn't know about it, or maybe they're not telling their clients about it because they may not personally benefit if somebody goes and starts self-directing. Okay, it's kind of the DIY of investing, because we're not looking to replace a financial planner, but a financial planner doesn't necessarily benefit from you having a self-directed IRA. So they may or may not know about it, but they may also just not tell you about it because it's not in their portfolio of what they can offer. And then it's been around, under Internal Revenue Code Section 408. So benefits, again, non-traditional assets, you can truly diversify. Investment returns are tax deferred, and no capital gains on the sale of real estate. And then you can actually get a loan, what's called a non-recourse loan. And some of this, by the way, applies to both the IRA and the 401k. And so the non-recourse loan is part of that, and which essentially means you cannot personally guarantee the loan. You are the only security for the loan is the property. So if in the event that the retirement account defaults, the lender takes back the property. So your personal credit, your personal income, all that is not taken into consideration. You cannot actually, because you are a disqualified party to the retirement account, so you can't personally guarantee a loan. That's why it has to be non-recourse. And you do have to have some reserves. You do have to have, 40 to 50% down, give or take. And we do have, we have on our website, we have a list of non-recourse lenders if you want to check that out. You can actually hover over the solo 401k or IRA drop-down menus in the top right, and then under each one of those is that same page of non-recourse lenders that you can call, and they all have some different terms and plans that you can look at, and interest rates and all that stuff. So that's the non-recourse loan, which again goes to the IRA and to the 401k. So there are two types of self-directed IRAs. There's the full, I call it a full custodial IRA, because you do have to still have a custodian with an IRA no matter what. But I'm going to talk about the full custodial IRA here, and I'll explain what that means in a second. Having a full custodial IRA means that you have to go through the custodian, which, think about Fidelity, Vanguard. They may say that they offer a self-directed IRA. Technically, they don't, because you can only invest in what they offer, which is really stocks, bonds, and mutual funds. But they call it self-directed. That's custodial. That's where you have to go through the custodian to make investment decisions. Now, there are companies that offer full custodial self-directed IRAs that will allow you to invest in alternative assets. What happens is, if you're looking to invest in something, you have to go through the custodian for them to write the check. Okay, the custodian goes on title to a piece of real estate with a full custodial account, okay, for benefit of your retirement account, right? They write the check, they send the wire for the money to buy something or to invest in something, whatever the case may be. If you hold real estate and you're paying a property manager every month, it's probably coming out of the rents. But if you have to replace something or fix something, or write a check, you have to go through the custodian to do that. So it's a little more work. And then there can be some red tape involved, some lack of control. Yes, a little bit of time involved. And some extra fees. There are some companies that do charge transaction fees each time you do a transaction. There are the companies that have a flat, annual fee that has kind of an all-inclusive. And so they all operate a little bit different as far as their fee schedule goes. And but they can charge per transaction for issuing a check, purchase and sale, transaction fee, asset fee. The list goes on if they have their business set up that way. Now, on the other side, which is what we have, is the Checkbook IRA. So we decided a long time ago that the best way to do this was to give people what's called checkbook control. So with the IRA, we set up an LLC. This is a special purpose LLC. This has nothing to do with you personally, has nothing to do with any LLC you have already set up for whatever else is going on in your world. This is created with special language, special purpose to be owned by the IRA. And so it requires that IRS compliant setup and operating agreement to go along with it. And that is what gives you checkbook control. So it allows you, as the manager of the LLC that the IRA buys 100% of the units of, to bypass the custodian when making investments and transactions. Again, you do still have to have that custodian, but you don't have to go through them each time you're making an investment or paying a contractor or whatever the case may be. You just write a check or do online bill pay, and you can bypass the custodian. So here's how it works. So first step is a new account is opened with an IRS approved custodian. Then the qualified transfer is set up. So the IRAs annually have a contribution limit of $7,000 if you're under 50 or $8,000 if you're over 50. Okay. So, and that's the same with the self-directed IRA. So most people don't start out with a self-directed IRA from $0. They actually transfer another IRA or former 401k, 403b. Any qualified retirement account can actually transfer into the self-directed IRA. And most of the time, that IRA that they're rolling over has been built up over a number of years. It's a former employer 401k. So, it's got a substantial amount of money, or, typically 25 or 30K minimum, because while you can start out at zero, it's hard to invest in alternative assets with less than between $20,000 and $30,000, right? And you're probably not going to buy real estate with $20,000 or $30,000, but you can do private lending, and you can build that up through an interest rate of, maybe 10 to 14%, give or take, and eventually have enough money in that retirement account to invest in a hard asset like real estate if that's your goal. Okay, so after the transfer, the LLC is designed, again, special purpose, single member LLC. Then the bank account, the LLC is funded. Okay, so the transfer is set up. It's held in an IRS approved custodian trust account. Once the bank account, the LLC is created, bank account is opened, then the money can transfer from the custodian into that checking account. Okay, and that checking account and all other accounts you open and everything else you invest in, whether it be real estate or anything else, is going to be in the name of the LLC. Okay. And all income and all expenses need to go into and out of that checking account, cannot commingle any funds. What are some more advantages? Well, we talked about it. You get to bypass the custodian, speedy transaction, direct access. You do get some added protection from litigation with the LLC, limited liability. That's what it is, limited liability corporation. I will say, I am not an asset protection attorney. I'm not an attorney at all for that matter, but personally, and we definitely recommend others get a umbrella policy as well on top of any other asset protection they're trying to do. Umbrella policies are super cheap annually, and you can get $1 million umbrella policy for a couple $100, maybe $300 a year. So it's not bad at all, and that helps with that protection as well. There are, they're fixed actually custodial fees. Okay. So there's no transaction fees. There's no asset-based fees. It's fixed. And then I already mentioned you get to hold assets in the name of the LLC as opposed to in the name of the custodian. Okay. So now we're going to switch gears. We're going to move over to the solo 401k. So by the way, let me back up a little bit on the IRA. You can do this in a pre-tax IRA. You can also do a Roth IRA as well. Okay. So all the income and everything else that goes into the Roth, is not taxed upon withdrawal during retirement or distributions. Whereas, of course, the pre-tax, the gains are tax-free, but you do pay taxes on the whatever your tax rate is upon retirement when you're doing your distributions. So switching to solo 401k. So it's under subsection K, section 401 of the Internal Revenue Code, and it's just it's defined as a retirement savings trust. I mentioned already at the beginning, it is designed for the self-employed or small business owners, hence the word solo. And it's a simple 401k plan that covers the owner and their spouse. And it's actually made possible from 2002, so 22 years ago, as a result of what's called the EGTRA law. And that law made many of the current benefits of the 401k possible. Eligibility. Okay, so IRA, anybody, solo 401k, not everybody. You have to have legitimate self-employment activity. It cannot be a hobby. If you're wondering if you have a hobby or not, here's an example. And you can even go on the IRS website. They have a good article about what the definition of a hobby is based on their definition. But an easy definition is basically you have a camera. Maybe you buy some camera equipment for a couple $100, maybe $1,000, and you're taking photos of friends, and maybe you go bird watching and take photos of birds, but you're not necessarily making money. It's not a business, right? You might be kind of in business, but it's more of a hobby, right? You're not making a profit really doing it. Maybe you're making $1,000 a year or something, breaking even. I don't know, but it's really just a hobby. Okay, that's a hobby. Business is something that you're in business for, self-employed, sole proprietor, single member LLC, partnership, S corp. It can be any of those, all of the above. But you're in business to make money. Okay, you could be a doctor, an attorney, property manager, network marketing. Of course, will take anybody. Consulting. A lot of our clients are consultants. They work for 20, 30 years in an industry, and then they have enough head knowledge to consult for people in that same industry. And so they open up a consulting business. We have nurses that actually have a W-2 job as a nurse, but then on the side, nights and weekends, they go out and they do contract work, and they get a 1099 for contract work as a nurse. You could be a flipper, wholesale, day trader, contractor. The list goes on. With the gig economy, it's not hard to become self-employed because even an Uber driver qualifies, right? They're getting a 1099. Most of them are probably sole proprietor, but it doesn't matter. You could be incorporated too. And so you're self-employed at that point. Now, the other requirement is the absence of full-time employees, which is defined as less than 500 hours per year. Okay, there are some exceptions to that if they're under 21 years old, and if I think it's the first couple years doesn't apply. But essentially, other than you and your spouse, you cannot have any W-2 employees that work more than about 10 hours a week. Okay, so those are the two requirements. How does it work? Well, you have to have the plan sponsor, right? The 401k is based on a company and it's sponsored by that company. I already mentioned it can be any sort of setup, any sort of sole proprietor, corporation, etc. And then that company sponsors the plan, and a trust is created. So unlike the LLC IRA, it's actually a trust that's created, of which you, as the business owner of the retirement plan, you are the trustee. So the IRA owns the LLC, the 401k owns the trust. You're the trustee, you're the manager. That's how you get what's called checkbook control. There are custodial solo 401ks as well. In this case, a custodian is not required like it is with the self-directed IRA or any IRA. So the trust is all you need, and you have checkbook control. And as the trustee, you get to open up a bank account. The trust holds all the assets, and so you can use that trust with the checkbook control. Doesn't just come along with being able to write a check for an investment. It comes along with being able to open personally with the trust, not personally in your name, but in the name of the solo 401k trust, gives you that power to go open up bank accounts, brokerage accounts, whatever. You may want to invest in alternative assets, but you may also want to invest in stocks, bonds, and mutual funds of some sort. Maybe that's how you want to diversify. There's nothing wrong with that. You can open up a brokerage account at Vanguard, Fidelity, T. Rowe Price, whoever, and you can invest in what they offer. In addition, you can invest in alternative assets. So the home for all that money is the checking account owned by the Solo 401k trust. From there, the assets, the liquid cash is deployed into different investments. So that's how that works. And then just like the IRA, no commingling of funds, all the income, all the expenses must go into and out of that checking account. So that's how that works. The benefits, it has very high contribution limits, up to $69,000 if you're under 50, up to $76,500 if you're over 50. And where the IRA, we talked about it, 7,000 or 8,000. Okay. You can take what's called a participant loan. Some people call this a line of credit. Maybe, I don't know. I think it's just called a participant loan, but you can use that money for what would otherwise be a prohibited transaction. So a really cool story is we had a prospective client come to us and say she wanted to, she was talking to her CPA. She had some high interest credit card debt, about $20,000, excuse me, about $10,000 that she wanted to pay off. And the CPA said, well, you can, she didn't have the money. She wanted to get rid of it. All right, you've money in this IRA. You can take a distribution, but you're going to pay taxes and penalties. So you better take out $20,000 to cover that. Okay. Then she stumbled across us somehow. She became a client, told us her situation, became a client, and she took this participant loan. And instead of taking the hit and paying Uncle Sam penalties and taxes, what she did is she paid herself back. So she took out the 10,000, not the 20, because it was just the same amount, dollar for dollar. Then she did have to pay it back, but it was at a prime interest rate plus 1%. And so but instead of paying Uncle Sam or some other bank for a loan or whatever, she paid her retirement account back. Okay. Now that has to be amortized over up to 5 years, and it can be paid back quarterly or monthly. It's up to you. You choose that when you're filling out the loan information, the loan documents. And then if you use that money to put a down payment on a personal residence, you can actually amortize it over 15 years instead of 5 years. So, and the limits are up to $50,000 or 50% of the total plan assets of the 401k, whichever is less. And unlike the self-directed IRA, where you have a Roth self-directed IRA and you have a traditional pre-tax self-directed IRA, with the solo 401k, it actually has a Roth sub-account built in. So it's pretty cool. It's literally two separate checking accounts, and you can custom name the checking accounts online at the banks, and you can say pre-tax a checking account on one, and you can say Roth checking account on the other, whatever you want to call it, just so you delineate the difference between the two. But that's how that works. And I will talk about Roth contributions and conversions. You can do a Roth conversion. Essentially, you can take pre-tax money in in a traditional IRA, and you can convert that to Roth. Okay, so there's different ways to do that. For example, if you had $100,000 in a traditional IRA and you said, I can take the tax hit, I want to convert this to a Roth. You could take that 100,000, do the Roth conversion. Now your income, your earned income for that year on your tax return on your 1040 is going to increase by $100,000. Okay, so talk to your CPA about what that looks like and what it's going to cost you. But maybe it makes sense now for the life of that 100,000, all that 100,000 and all the income from it and all the gains and everything is going to be tax free. Additionally, with the Roth, it's important to note you can take out your principal that you put in at any time because you've already paid taxes on that, right? If you're going to take distributions on your Roth at retirement, you actually it has to be in there for 5 years from the date of the first contribution for the Roth or the date 5 years from the date of the conversion. So each conversion from pre-tax to Roth has its own 5-year plan behind that. But I'm getting into the weeds a little bit on that. I just get excited about the Roth because the power of making as much money as you can and then taking it out tax-free down the road just blows my mind. So anybody and everybody should have a Roth as soon as they can. And it is cost effective. It's much less to set up. It takes 4 days versus almost 4 weeks to set up. Well, between 2 and 4 weeks on the IRA LLC, depending on how fast the client moves. But the 401k, the solo 401k, is only about 4 days, and it is easy to maintain. So let's talk about the contributions. So the Roth contribution, not conversion, contribution must come from the employee elective deferral. Okay. So you have, this is just like a 401k at a job, at a W-2 job, right? You have the employee deferral, 23,000 per year plus 7,500 if you're over 50. Okay. You have that also with the solo 401k. Now the contributions are made from the self-employment earnings, right? But you can contribute up to 100% of your self-employment earnings. What that means is if you have a 9 to 5 outside of your self-employment that is sponsoring a solo 401k and you're living off that 9 to 5, that's a W-2 job. That's fine. But you have this side hustle. Maybe you have a real estate license or you do photography at a high level and you have a side hustle. If you paid yourself 23,000, if you made 23,000 net, you can actually, not net, excuse me. If you made 23,000, you can contribute 100% of that into the solo 401k if it's 23,000, right? Or 30,500. The contributions, if you're on payroll, they must be made within 7 days of paying yourself. So you can't, once the year ends, those are, you're done with the contributions for the prior year once the year ends, unless you can do it within that 7 days. But if you're a sole proprietor and you're just taking distributions as owner distributions from your business checking account, you can actually contribute the employee elective deferral and the tax deferred employer profit sharing up to the date, right before you file your taxes. So April 15th or October. I'm not sure what that date is, I forget, but if you extend all the way up to October. And so you have the employee elective deferral, 23,000 plus 7,500 if you're over 50. And then on the other side, you have the employer profit sharing. You do not have this with a W-2 401k. Now, this is where you get from 0 to 69,000, or from 23,000 to 69,000, or from 30,500 if you're over 50 to 76,500. I just threw out a lot of numbers. Just remember 69,000 or 76,500 if you're over 50. And you can, on the employee profit sharing side, this is a business expense for your business, your small business. You can contribute up to 25% of what you pay yourself if you're incorporated. And then if you're sole prop or single member LLC, you can contribute, up to 20% of the net profit of the company for that previous year. So the total limit there on the bottom, 69,000 versus, or 76,500 if you're including the catch up. And just to be clear, I said it, but I kind of said it fast. You don't have to do the elective deferral at all. If you have a W-2 job and you're maxing out that 401k, as many of our clients do, it's only one employee elective deferral per person per year. So if you're putting 23,000 and you're 45 years old into your W-2 401k, you actually don't have any more on your solo 401k sponsored by your self-employment activity on the employee elective deferral. But you can go from 0 to 69,000 or 76,500 using the profit sharing. Okay, so that's how that works. It's just calculated at 20% or 25% in those regards. So hopefully that makes sense. By the way, if anybody has any questions, I know I'm giving a lot of info. We will absolutely give time at the end. Please type your questions in. We'll go through them. Just type them in along the way so you don't forget. You can purchase real estate. I've already talked about that. The income and gains are tax deferred, or if they're in a Roth, they're tax free, right? The income, just to reiterate it, there's no commingling. The income must go back into the checking account and expenses must be paid from the account. And we talked about the non-recourse lending that you can get. Again, we have non-recourse lenders on our website. Reach out if you can't find that. But it's SenseFinancial.com /non-recourse lenders. And another difference between the IRA and the 401k has is, with the 401k, there is no UDFI, unrelated debt finance income, on leveraged real estate, on real estate with a mortgage. Okay, you do have that with an IRA. So and that actually triggers what's called UBIT, or unrelated business income tax, UBIT, which they can scale up to 37%. You'll have to check with the CPA as to what gets you up to 37%. I think I heard one the other day, or an attorney say something about $12,000, but don't quote me on that. So, but you can get up to 37%. Okay. So it's okay. It doesn't mean don't own real estate in your self-directed IRA. It just means plan for that tax, whatever it's going to look like. With the solo 401k, you don't have that. So that's another advantage of buying real estate with your solo 401k. If you're going to use leverage, which many of our clients do, so that they can buy more than one or two properties, they can buy more real estate with leverage, right? And then this is just a one screenshot of the differences between the IRA and the LLC. And you can see that, the self-directed IRA on the left, that's the full custodial account we don't offer. The IRA, LLC, and the solo 401k we do. And so you can see just some of the differences there. With the solo 401k versus IRA, primarily no custodian. You can do the personal loan. You can do the participant loan. It says personal loan there, but I should change that to participant loan, because that's technically what it's called. And then just the contribution limits are just monumentally different. Of course, built-in Roth, that's a big difference. And then of course the other one is the requirement of self-employment. So one last thing, if you haven't seen this or downloaded it, it's totally free. Just go to SenseFinancial.com/IRA-makeover, and you can download the ebook that Dimitri, the founder of our company, wrote. And it's not just about IRAs, just says that, but we're making over an IRA, right? It can be going into a solo 401k or transferring to a self-directed IRA. So it covers 401k and IRA. Really, really good info. I highly recommend checking that out. If you do want to get on my calendar, more than welcome to. We offer completely complimentary consultations. You can go to that URL there on the bottom, SenseFinancial.com/free-consultation. And that'll get you to the calendar, and you can book a spot that works for you. And at this point, we will take questions. So thank you very much for listening to me ramble on for 32 minutes or whatever it was. I appreciate it. But what questions do we have?
We have a few questions here. If anyone else has questions, go ahead and type them up in the Q&A section so Brett can answer them. This question is from Min. We have shares of land owned by a self-directed IRA. Can it be transferred to your checkbook IRA?
Shares of land yes. Yeah, absolutely. You would have to, so I assume that's a custodial self-directed IRA. So we would have to create the plan documents and the LLC that goes along with it. So in that situation, we treat you as a brand new client, which you would be, but the setup and everything would be as if you were a brand new client. What you would need to do, though, is you would need to retitle that asset into the name of the LLC. If you don't want to do that, I don't know what your disposition is with those plots of land or the specific situation, and we can talk offline if it makes more sense. What you can do is you can keep those assets in that already existing self-directed IRA, start the checkbook control IRA LLC, invest in other assets until you dispose of or sell those plots of land, rather than having to deal with like retitling them in the name of the LLC to get them out of that existing self-directed IRA into the new one with checkbook control. It might be easier to just have both of those accounts simultaneously. But again, I don't know what your planned disposition is with those plots of land. Hopefully I answered the question. If not, I'm definitely happy to talk to you offline. So just book a call with us and we'll talk. By the way, you guys can also call me directly or send an email. You don't have to go on the calendar and book. So I'll throw that out there too. But hopefully that helped.
Another question from Min. Does the IRA LLC need to file a tax return? Can I do it myself, or do I need to hire a CPA to do the IRA LLC tax return?
Well, that would be up to you. I mean, anybody can do their own taxes, right? The IRA may have a tax return. Again, if there is UBIT tax from UDFI, or the other thing we didn't talk about is that you can have UBIT tax when the IRS determines that you're running an active business within your retirement account. This goes for IRA and 401k. If you are running a business like a flipping business, or it doesn't matter what it is, um, you can actually I just realized we didn't talk about prohibited transactions and disqualified parties. I gotta cover that for a second here. But to answer Min's second question, um, which I just totally lost. Read the question again. Sorry.
It's about filing the tax return.
Yes, thank you. So if you have UBIT tax, there is a tax return for the IRA called a 990T, and you can fill that out on the IRS website and submit it yourself. You can you can hire a CPA to do it. I don't think it's that complicated, but mind you, one of the things that you're going to be responsible for, you're the trustee, you're the manager of the LLC. You are fiduciarily responsible for the bookkeeping and keeping track of all the activity of the retirement account. And so as such, you're going to keep really good records of what you do. And so doing these, the 990T or a 5500 EZ, which comes into play in the 401k when you have when you have $250,000 or more of total plan assets, the beginning of the year versus the end of the year, then you are going to have to file that 5500 EZ. It's 2 pages. You can do it yourself. We can help you with that. But as far as the 990T, CPA or you can do it. Yes, to answer that question. And then I got to talk about prohibited transactions real quick. So your spouse, your children, their spouses, your parents, your grandparents are what are called disqualified parties to the retirement account. So what that means is you cannot invest in a business that's owned by one of those people. They're disqualified. That would create what's called a prohibited transaction. You also cannot perform what's called sweat equity. You cannot do any work on behalf of the retirement account. So think about white collar work versus blue collar work. You can do white collar work for the retirement account. If you're looking up properties that might be a good deal, you can spend time on your computer doing that. You can hire a contractor. What you cannot do is go swing a hammer. I'm a licensed agent. If I wanted to go out and find a property for my retirement account, I could find the property, but I can't represent myself. I can't do any work on behalf of the property. So just think about work, and the difference between what's allowed and what's not allowed is white collar versus blue collar. Okay, I would have to hire another realtor, another brokerage, not brokerage, but another realtor to represent me, not me, my retirement account on that transaction. So that's just a short definition of disqualified parties and prohibited transactions. There's a little more to it, but essentially that's how that works. So I apologize. I meant to cover that in the presentation, but Min's question somehow sparked that. So I appreciate it.
And a third question from Min. How much LLC fee does the IRA LLC charge?
Well, Min, are you asking what we charge at Sense Financial to give you the vehicle to do this? Is that the question?
Could possibly be the question, if you want to cover that.
Yeah, I can cover that. So we have for the IRA LLC, we have a $2,000 establishment fee. Okay. We have an annual fee that starts in year number 2 of $250. And we have for the solo 401k, it's a $600 establishment fee and then $250 starting in year number 2. We have no other fees. There's no establishment fee. There's no asset-based fees. There's nothing. We don't even know how much money you have unless you tell us. So those establishment fees go to create the trust. the plan documents, again, the vehicle that allows you to do this on the IRA side, the LLC creation, what the state charges to do that, and then also the plan documents on that side. So those are our 2 fees. And we do have some special web pricing. If you contact us, either book a call on my calendar or just call us directly, we do have some special web pricing that we may be able to offer.
Okay, next question here is from Irma. I own one rental property. Would I qualify for solo 401k?
Irma, I am so thankful that you asked me this question because I meant to cover it in the self-employment conversation in my presentation and I spaced on it. So thank you. Rental income is Schedule E income. That is considered passive income. That is not an active business. That does not qualify you for self-employment activity. However, what you can do, Irma and everybody else, if you own rental properties already, not in a retirement account, outside a retirement account, you can very easily create a property management company, especially if you're already managing the properties. You might as well get another benefit from it and make yourself eligible for a solo 401k. We have a lot of clients who come to us and they're living off the Schedule E passive income from their rentals, which is amazing. I love that. But they want to do a solo 401k because of the benefits over and above a self-directed IRA. And so they go and they create a property management company. Again, it can be sole proprietor, S Corp, whatever. And now they're eligible for a solo 401k. Now, bear in mind, this part of the advantage of the solo 401k is the high contribution limits, right? So, and those contribution limits need to come from that business revenue. So if you don't have business revenue coming in, even though you qualify for a solo 401k at maybe a couple $100 a month in property management fees, it's not going to give you a lot of contribution to put into the solo 401k, but you can still roll over any existing qualified retirement account, or QRA for short, into that solo 401k to be able to then self-direct. So hopefully that answers the question. You can go crazy on YouTube, Irma, and everybody else, and just search like, what kind of property can I create when I own, or excuse me, what kind of business can I create when I own rental real estate? And there's other ways to create like asset management companies and property management, and there's other things that you can do. But again, it's just legitimate self-employment activity. So it doesn't take much. You could walk dogs, once a week for a living and be self-employed. I have heard Dimitri tell people that if you have your real estate license, if you sell one house every other year, that's enough to qualify you for self-employment. So it doesn't take much.
Okay, a question here from Jim. Can a solo 401k be set up for a brand new business, or is it only for a business that is already in operation?
Another great question. Did you give them these questions, Natalie? Because these are amazing. All things that I
I wish.
should have talked about during my presentation. But so the answer is yes, it can be brand new. It can be established for 25 years. It doesn't matter. In fact, you can actually, let's just, for example, say that I want to start a business fixing and flipping single family homes. Okay. I don't have a home under contract, but I'm going to start this business. I could go out, I could order business cards. Maybe I have some advertising going out. Maybe I start knocking on some doors. Maybe I meet with a local title rep to get, some ideas on demographics and activity in certain areas that I should, farm in, or that's a realtor term, but that I should drop mail in, or direct mail, or knock on doors, or cold call, or whatever, right? You're getting your business started. You don't have anything under contract. You don't even have a business checking account, though you probably need to do that sooner than later. You can start the solo 401k. That can be the sponsoring business. It's perfectly okay. Now, if you're going to do it that way and you don't have an established business yet, make sure you follow through with that business, especially if you roll over or transfer money from another qualified retirement account into that solo 401k, because what you don't want to have happen is not get off the ground with the self-employment, and then not too far down the road, maybe 6 months or a year, we find out, or you tell us, or whatever, I never started, and now your 401k is actually illegitimate. It's not able to be a 401k anymore. So we have to figure out how to unwind everything that was done, and hopefully not create, hopefully not have created some taxable or just early distributions, which is easier to do with a 401k if there's a mess up than it is with a self-directed IRA. But that aside, great question. So hopefully that answers it.
Okay, well, those were all of the questions. Is there anything else you want to add, Brett, before we wrap up today's session?
Yeah, just thank you everybody who joined. We really appreciate it. And like I said, jump on my calendar. Happy to talk. I feel like here at Sense Financial, Dimitri's done a great job with our core values, and we are happy to have a conversation. And we have the hearts of teachers. There's not going to be any commission breath or hard selling going on. So just jump on a call. We're happy to have a conversation and see where it goes. But otherwise, thank you very much, you guys.
Thank everyone for joining, and hope you all have a great day.